Okay, well, it's time to boil things down to stocks, and our research team is standing by with the CNBC TV 18 list of top stocks to watch out for the day. Guys, good morning, and thanks for joining in. Abhishek, have to start with you. Bajaj Finance, now the Q4 update was in, so we already knew that they're doing, quite well in terms of growth, but margins, I mean, what's your read-through?
Well, the NI growth has been pretty strong, up about 28% YOY and about 4.5% sequentially. So the net interest margin on a calculative basis has declined by 32 basis points. Motilal Oswal was expecting a 30 basis point decline, so largely in line with respect to net interest margin as well. And that has translated into operating profit growth of about 29% YOY and about 5.5% sequentially. Provisions have remained under control, and you have seen lower OPEX this time around, and that is why PAT growth is at 30.5% YOY and about 6.2% sequentially. So both in terms of NII and PAT, it's a beat on our poll. Asset quality has improved. Gross NPA ratio is down by 20 basis point and net NPA ratio by about 6 to 7 basis point. In the conference call, the management has highlighted that they will see a net interest margin compression of about 40 to 50 basis point in FY24. However, they have also guided for loan growth to be much better than their previous guidance. So the new guidance of loan growth is about 28% to 29% for FY24 versus the earlier guidance of 26% to 27%. Back to you.
Okay, all right. Thanks a lot for that, Abhishek. Well, let's hop across to Surbhi, who's here to track a couple of those life insurance companies, HDFC Life and SBI Life. Surbhi?
Thanks so much for that. So HDFC Life and SBI Life both reported a good set of numbers, and that was on expected lines as life insurance players were positively impacted by the recent budget changes. Now let's start with HDFC Life first. For Q4, the company reported an APE growth of 69% on a year-on-year basis. Now this growth should be taken with a pinch of salt as it was largely due to pre-booking of non-linked policies. The company did mention that 35% of total business in Q4 came from these high-ticket policies. On the back of this, the VNB also saw a growth of 69%, but the margins were largely flat at 29.3%. Their embedded value for FY23 saw a growth of 32%. Now, this growth in embedded value is positively impacted by a 3,000 crore expense due to a merger with Exide Life and a 2,000 crore capital infusion by the promoter. For FY24, management has guided that they expect to continue their VNB growth along with faster than industry APE growth, but the margins will be maintained at FY23 levels. Apart from this, just a few days back, HDFC and HDFC Bank are now allowed to increase stake in HDFC Life, which will remove a technical overhang and aid the FY24 growth. Now moving on to SBI Life, they too reported a good set of numbers. Now remember, this company was least impacted by the budget changes, and despite that, they have reported an APE growth of 10% in Q4. The real surprise in their results is their VNB and VNB margins, which were much better than expectations. VNB was positively impacted due to a decline from their ULIP contribution. They saw a VNB growth of 23% and margins have expanded by 320 basis points, came in at nearly 32%. Their embedded value was up 16%, and that's good growth considering they had a close to 2,400 crores of negative impact from economic variances, largely on account of changes in bond and equity movements. Their return on embedded value was also higher, came in at 23% versus 21% in FY22. For FY24, they are expecting an APE and VNB growth in the range of 20 to 25% and VNB margins similar to that of FY23 levels.
Surbhi, thanks very much for that. But technology companies continue to come out with numbers. L&T Tech reported, Coforge reported, and in the telecom space, Indus Tower reported numbers as well. Rima is here with a wrap-up. Rima.
Thanks so much for that. Let me start with Coforge since it just announced their numbers. Strong top-line performance. Dollar revenue growth 5%, constant currency revenue growth 4.7%. So it's a good number on the top line. Margins and profits, though, have come in lower than expectation. One, there is an exceptional charge of 52 crore. The company was planning an ADR listing. Now they're not because of the market conditions. So there is a provision on account of that. Two, the company has achieved a milestone of $1 billion of annualized revenues. So the company is celebrating and they're handing out iPads to every employee, and that's going to result in some payout as well. So X of that, actually the numbers are pretty good. So that's the reason why your margins and profits have come in lower than street expectations. FY24 constant currency revenue guidance is healthy at 13 to 16%. Let me move on to Indus Stars, where it's not a bad performance. If you remember, in the prior quarter, Indus Stars' performance was hit on account of provisions made for Vodafone Idea. But this time, things are improving. Revenues are flat, but EBITDA margins are finally now back above that 50% mark as it used to. Gross tenancies are up 80%. Receivables that they were expecting from stressed telecom players and other vendors have come down on a sequential basis. And the company has said the Vodafone Idea has been paying its monthly billing from January of 2023. And L&T Tech also not bad. Q4 revenue growth has been better than what the street was anticipating, though margins are slightly short. But FY24 guidance is healthy and ahead of street expectations. Back to you.
Okay, got that, Rima. Thanks very much. iPads to employees, I wonder, maybe that drives productivity, happier employees. Anyway, speaking of L&T Tech, we'll be speaking with the management in a bit from now. Amit Chadha, MD and CEO, will be joining us in the next few minutes as well. All right, let's keep it with the numbers. We have Surabhi back with us on Voltas's numbers, where we saw a fair amount of pressure on margins. Surabhi.
This is a disappointing set of numbers by Voltas. Even though the revenue was up 11% in line with the poll, it was a miss in the EBITDA and PAT, which is a disappointment. Now, the gross margins were also lower by 120 basis points, came in at 21.6%. EBITDA was also impacted by higher other expenses and high employee expenses. EBITDA was down 16%, and margins have come in at 7.4% versus 10% last year. Their unitary cooling product segment did not do that badly. The segment saw a revenue growth of 13% and profits were up 7%. The company said that they did achieve volume growth despite the weak consumer sentiment. But the market share, however, remains a concern. The market share came in at 21.9%, down 60 basis points from December. Given the increased competition in the segment, market share remains a key concern. The EMP segment saw good revenue growth, but they've accounted for some delay in collections, which have affected their profitability. And engineering products continue to see improved performance, saw a revenue growth of 15%, and the profits were up 37% over there.
Thanks a lot for that, Surabhi. Abhishek is back with us. Abhishek, tell us about Can Fin Homes. How are those numbers?
Well, the employee attrition that's been having at Can Fin Homes has had some pressure on the disbursals. So the numbers are not bad, given the fact that despite the new management coming in or the new MD coming in, asset quality has largely remained stable or has improved actually. So to start with, the net interest margin is at 7-quarter low of 3.37%. It is down about 10 basis points on a sequential basis. The disbursals are down 6.2% YOY and up about 3.85% quarter-on-quarter. Q4 being a seasonally strong quarter, but it has had its impact due to employee attrition that's seen in Can Fin Homes. So AUM growth, first time in last 4 to 6 quarters, is below the 20% level, coming in at 18.2% YOY and about 4.8% sequentially. However, the return ratios continue to improve. So ROA is at 2.32%, which compares to 2% in the same quarter last year and about 2.16% in the previous quarter. Asset quality has improved, which is a positive surprise. So it has come in at 0.55% versus 0.64% in the previous quarter. And in terms of NII and PAT, it's ahead of our poll. Back to you.
All right, Abhishek, thanks very much for that. Now, Syngene and Gujarat Gas are the next companies which reported. Ekta has got details on both. Ekta.
Thanks for that. Well, I'll start with Syngene. Good set of numbers. Revenue up 31%, margins 31.6%, profit, which was better than estimates as well. They have also beaten their revenue and profit guidance for FY23. So it was up 23% for FY23 versus a guidance of high teen revenue growth, 29.3% margins versus guidance of margins of around 30-odd%. Profit up 17% versus guidance of profit in single-digit growth. Now, one of the key products, which is from the animal health space, has helped their numbers, but nonetheless, very strong numbers for Syngene. Gujarat Gas sources have indicated that they have cut prices with effect 1st May for the industrial segment. ISEC has written on this. They have said that they have cut the Morbi industrial prices by around 5 rupees. This is to keep prices competitive with the recent lowering of propane prices. Industrial prices are now at around 39.5 and industrial prices for non-Morbi stand at around 47 rupees per SCM.
Okay, got that. So Gujarat Gas is going to be in focus as well. Thank you, Ekta, for the details there. Let's quickly recap our list of stocks to watch then. The ones that have positive news flow around them are Bajaj Finance, HDFC Life, SBI Life, L&T Tech, Indus Towers, Canfin Homes, Syngene and Gujarat Gas. Stocks with negative news around them are Coforge and Voltas, both on earnings. All right, with that, let's take it to Manisha Gupta and find out what the commodity headlines are looking like. Manisha, the crude